All right. Good early Sunday morning, peoples. Um, as you guys know, I've done a lot on the high yields across several curve, um, yield max, obviously, Defiance, Granite, Rex. So I'm adding more and more. And what I really wanted to do additionally, and that's what this video is about. So I'm looking to attract a larger audience, and these are more conservative, but kind of the best of the conservative. And this is really coming out of me building the database I've been referring to. And at the very end, I'll touch on that with these four funds. But from the title, these are four funds, large ETFs. Some of them been around 14, 15 years, some of them only 2, 3 years. Uh, but they're all highly rated. They all have dividend, but they participate in growth. So let's talk about them one at a time. You can see on my screen here, I've got Schwab SCHD, one of the most popular, I think VU, there's a few of them. Um, but I think from a performance perspective, that SCHD is right up there. So let's talk about how they do in a good market, in a bear market, in an average market, and just kind of understand the fund a little bit better. So when they make these funds, what kind of criteria and selection process do they use? Well, number one, for SCHD and its swaps, cash flow to total debt. Whoops, got a little typo there. How about DEBT? All right. Return on equity, dividend yield, 5-year dividend growth rate. You see that a lot in the more conservative. I mean, that's a Buffett type thing where, well, I don't buy stocks unless they have a 10-year record of increasing their dividend over every year. So it's like, wow, that's 40 quarters of time, right? So one of the things is what is FCF? You'll see that a lot. Free cash flow. What is that? Well, that's operating cash flow minus capital expenditures. So FCHD has a pretty sophisticated selection criteria to then pick the companies that they hold. Well, let's talk a little bit about what they hold. And I'll jump right in because I'm going to do this for each one of these funds. Um, so I'm going to look at dividend yield. What kind of grade does it get by some of the companies that go out and grade these companies? Well, overall, FCH's dividend grade is A plus. So that's outstanding. So the dividend yield component of the overall dividend grade score is a B minus, 3.53. So that means there's some other funds that will fall into an A, but they don't run A's everywhere else. The worst grade you see here is a C plus and a couple of B minuses. Then you got A plus, A minus, B plus. So this is an outstanding thing. So look at dividend growth rate, B minus, 12.23%. So it's consistently growing. Now remember, this fund, when I look at it, I think this is the 2011. I'll go into some of this data with you. This one I made, oh, you know what? I left it out on this one, both the assets under management, but what I do in a summary. So when I go to 3 or 4, I summarize the comparative, and that gives you their total assets under management and what their launch date is and everything else. So apologize. Some of these I put it in the individual fund, but I definitely sum it up for a comparative analysis. All right. So an outstanding company nonetheless, SCHD, or I should say ETF, right? So what do they hold? Well, if you look at the holdings breakdown, their largest thing is healthcare. Second is financials. Third is consumer defensive, um, energy, technology. So see a company, what you want is an ETF like the times we're having right now. I'm going to show you some performance that these guys have had recently and what they did in 2022 when we had a bear market portion of 2022, and try to compare all of these funds across these different environments and say, well, this one's a little bit better in this scenario, this one performs a little bit better here. But you can see owning a Pfizer and a BlackRock and a Coca-Cola and an Amgen, older tech, not your new leading AI stuff. Bristol Myers, AbbVie, Chevron in the energy, Home Depot and consumer cyclical, Pepsi and consumer. So you see a broad there, and their largest percent. Now, I think the drawdown of SCHD is they only have about 100 companies. You say only. Some of these have 400, some have 200. So the four that I'm going to give you are really top funds in performance and yield. Now, they're not going to compare to a yield max when you say I got a 90% yield, but again, is yield max going to sustain that in an Nvidia or a Misty on MicroStrategy? I doubt it. You know, you take the run while you can, and then when the market goes into, like I brought up in one of my other videos, we're talking 1966 to 1982, we may hit another period like that. I think it's a few years off, but the real question is we're going down in March. Is this a March, April, May? Is this a March only? Is this a 10, 15% drawdown? Or does it lead to something more serious and it's a 3 month, 30%? I don't know. Not everyone really knows that. I can give you opinions, but opinions are worth just that, right? We don't know. So this is key, knowing that you've got certain things in here. And I think right now, I would say in March with a technology drawdown, you don't want your leading sector to be technology. So these guys look like for SCHD, they're doing pretty well. You can see that their dividend yield's 3.53, their growth rate over 3 years, their growth rate over 5 years, their growth rate over 10 years, consecutive years of dividend growth. No wonder 13 years of dividend growth and A plus. All right. So SCHD, there's not too many income or yield investors that don't know of SCHD. I'll be honest with you, right? But I wanted to tell you a little bit about it and come out here and show you a few things. All right, let's look at DRGO. Who is DRGO? Well, let me take a look. It is iShares, which I believe is under BlackRock, but we'll just call it the the Definity group that it belongs to is iShares. Okay, dividend growth. Okay, is what this thing is looking at. Here's a 10-year total returns. Look at this. You got another long-term guy. So DGR, and remember what total returns are. I track total returns, but I'm not talking about dividends reinvested. So these are making the assumption in the total return that you have dividends reinvested. Okay, that's the difference here in their total returns. When I do total return, I add up how much yield did you get for the year, let's say, and then whether you had a NAV loss or a gain, and add those two percentages for total returns. And I'll show you my sheet on where all these guys are there. So what are the top 10 holding? And by the way, so this is similar, right? This is over a 10-year period, but look at the difference. They're saying DGRO over 10 years is 208, 195. I have it a little above 140 and around 115 here on SCHD. Why is that? Because you don't have, if you dividend reinvest over 10 years, your gain is more substantial. That's the old thing I said to you guys in a video not too long ago about liar's figure and figures can lie. It all depends. They're accurate figures. They're just showing you, they're embellishing it in the optimal return. You go, oh, 10 years, yeah, I want a 208% return or 195. Most people look at FCHD that are used to high yield and say, oh, yeah, but it only yields, so and so. So I'm going to pull these up in another, hang on, while I am going to have them over here ready to go. I'm going to get iShares and get Swab. So I've got these things up here for you guys on a different screen that I'll go over. All right. So when we're talking a 3-month yield, for instance, on FCHD, we're talking about 0.90. The last 12 months of yield, right, going back the calendar 1 year from where we are, you have a 9.5% yield. So that's very positive. SCHD does yield very well. And all the other ones that I have here, I'm going to compare. And I'll tell you right now that yield alone, FCHD is the winning yielder. So where is this coming from? The other one's coming out of growth, out of NAV, right? For your DGRO. All right. And so here's your holdings on DGRO, sorry. Johnson & Johnson, AbbVie, JP Morgan Chase, Exxon Mobil. Look at the tech, right? I highlighted it in green. The outperformance of DGR over the last 2 years, right? If you start looking at this chart, is due to its holdings of more technology names. Hence, if technology crashes or goes down significantly in a 3-month period during a year, what do you think is going to do better, DGRO or SCHD? I would tend to say SCHD, right, based on that. And some of the other ones I'm going to cover have more utilities when the market is volatile and a little bit more safety. Okay, so some Procter and Gamble's a consumer, Coca-Cola, Home Depot, right? All some consumer staples. You got your techs in here, and you got a variety of financials, energy, and healthcare. A couple of healthcare. All right, what else do I have in here? This shows you that we had a scenario. Anybody who's familiar with the 2022 timeframe, you know that overall we had a bear market. So what does that say about what's in here? Well, here's SCHD, here's DGRO, and black, since it's listed at the top, the black portion of the chart is symbolizing SCHD. So it performed about as well as DGRO. It looks like a little better. So in 2022, for the total year, FCHD only lost about -3%. Better than SPY, the blue guy, who we all know how well it's done in 2024, coming down now in 2025. But you would have want something that performs better with it, like a SPY, but you don't want it when the market is turning down. So DGRO had like -9. I'll have to look at that number. I think I typed in something. And DGRO, yeah, about -6%, I think, during the same period. So you had a 3% downturn in FCHD, and you had about a 6%. I'm not sure why that 9 is there in the writing. I probably was just trying to type something. Okay, so DGRO yields less than SCHD, about 75% as much, right? So one's 2% and the other's 3% on the short term, but that adds up over time. So total return is larger when the tech stocks are doing better. Somewhat of a perfect blend, maybe over the course of the year, because the bear markets tend to be 2, 3 months. maybe 6 months. That would be a very long. I'm not talking about a massive bear. I mean, you had a 1966 to 1982. You had a massive bear market. Essentially, the Dow, which was a big measurement in those days over the Nasdaq, was flat for 16 years essentially. So that's an ugly environment. You did not make money in the stock market during that period of time. If you were in residential and probably commercial, but I'm more familiar with residential. If you were in residential real estate, you were in a lot of other subsectors, you did very well during 66 to 82. But you didn't do well just owning the stock market. Okay. Companies must pay a qualified dividend. It's the same with SCHD. It's the same with most of these. And for anybody who's not familiar with what qualified means versus non qualified, I did a video on tax. I think it's about a week ago. Look on my channel and you'll see, you know, what stocks to buy and pay no income taxes. And then I also did one on ROC, return of capital, which is like that third category. But just knowing on taxes, you have really two categories with this return of capital being a third. And the two categories are non-qualified dividends, and then the other category is qualified, and you pay substantially more taxes on non-qualified than you do on qualified. For the most part, you pay nothing on qualified dividend up to a certain income level. The other thing to know, people, and I say this a million times and people still write in the comments, if you're in a Roth, a 401k, a rollover, and you're investing, you do not worry about taxes. You are not taxed while you're in that. When you get to be my age, then you have required minimum distributions, RMDs, and you do have to take some out. But that's a whole different scenario than paying the taxes while you're building it. I still contribute to my IRA. I maxed my rollover IRA this last year because I wanted a tax deduction on all the dividends I was getting. Now I have to turn around and take part of that, but it's still a small percent of the overall value. Okay, so let's look at this. These are the grades that I was referring to and showed you. So overall, these guys also have an A plus, but look at how it's broken down. They're not doing as high a yield, 2.18. We were like 3.53. Their growth rate is 525. We were like 12 in FCHD. Their 5 year, their 10 year, etc. Look at their 10 year though. It's pretty phenomenal. Um, and then they have 10 years here on their dividend growth. So another really good fund out there from iShares. Dividend, I'm not sure what it stands for. Let me type it in again. Dividend growth. Yeah, it's just known as iShares Core Dividend Growth. But DGRO, look it up for that. And again, I'll share some other stuff. Outperformed FCHD over the last 10 years. And the big outgrowth at the end. You see during this 18 to 20 run up and the SPY and the Dow, and then you had it again in QQQ and SPY here. So it will outperform, but in your bear market, not as much. It tends to go down when the tech and so forth goes down. Now it's got 400 holdings compared to FCHD's 100 or so. So with over 400 holdings, it does not allocate more than 3% to any holding. We were up in the fives and maybe sixes when we were in FCHD. Oh, four, I take it back. So DJRO is down in the threes, right? But it has a lot more. But in the tech sector, and even that's why the yield's not as high. You start figuring, that's just three names. That's 7% plus of the portfolio. It's actually 8. So 8% of your portfolio is not really getting any dividend. The big tech doesn't give you dividends. A few do a tiny bit, but most of them really don't. All right. So let's jump to our third. And this one, did I have this chart? No, I used the other chart method. Okay. So Fidelity dividend growth, right? FDVV. This is a phenomenal fund in its own way. Um, Fidelity High Dividend ETF, FDVV. So what I did here is I pulled a chart of a 3-year total return. Again, it's making the assumption dividends are reinvested. Okay. So you're taking them and adding, which it's different if you do that in a super high yield. I mean, these aren't super high yield, but over 3 years it adds up. So here's DGRO 31.08, SCHD, because it's a yield payer, much more of its money is probably 13, 14% is coming from its dividend yield. This is getting the growth in those techs. And now we introduce FDVV hitting 43.35. So I'm on my third of fourth, saving the best for last. All right. So what do they own? Okay, and what sector is good for them? Well, you can see right away if they've done well lately. Okay, what have you done for me lately? Look at this. Look at this outperformance from early 2022 or 23, sorry. So they were going down pretty aggressively in 2022 when the bear market hit, right? And look at FCHD, it's recovering. But once things plotted out and we got into 2023, look at the purple. Performs, performs, performs. And then the other guy with the tech stuff is DGRO. And then you have FCHD doing okay. It's just not, going to take off when the SPY and the triple Qs are going nuts, right? But that's a heck of a return for 3 years. All right, cumulative. Let's look. So Apple, Nvidia, Microsoft, Broadcom. I'd say that's some big tech in that. Targa Resources. Now you're starting to get into different categories. Philip Morris, Procter Gamble, GE Aerospace, Exxon Mobil, RTX Corp. So your technology, your industrials, right? Your Procter and Gamble, so forth. Your energy, Exxon Mobil, utilities, consumer defensive. This is broadly even some REITs and real estate, banks and financial services, certainly healthcare, consumer cyclical. I just abbreviated communication services and basic materials. They don't have any. This is what I was referring to, guys. I'll summarize this. You see it in this sheet. So when I didn't do it for SCHD, they've been around since 2011, the oldest of all of the ones I'm going to show you today. The newest one that came out in 2022, is give you a hint, is the one I'm doing next, right? So we go from 11 to 14 to 16, and we go from FCHD at 69.22 billion. GGRO is 31.15. And look at these minimum management fees, 0.06, 0.08, and then we jump to a 0.416. We also got the best performance on the upside. So a smaller fund by far, 4.87 billion, so just under 5 billion. Okay. So how'd they all do in the last bear market of 2022? So what's nice about FDVV, you see this highest growth, right? Up here, especially over this period of time. It really didn't do that badly. SCHD in that bear market of 2022 was down -3%. DGRO -8. Look at the SPY. I imagine QQQ was right there, probably worse. I should have added that. And then FDV was under 5%. So pretty close to SCHD. So it hangs in there somewhat in the bear market, but really takes off when its core cyclicals and its techs and so forth move. All right. So what's their screening process? A little bit different, but all these guys have criteria. That's the main thing. They don't just go chase. They view super high yield as a dividend trap, basically NAV erosion. Dividend trap is another word for NAV erosion, right? Giving you back your money, return of capital. Okay. Why utility holdings? Got a little bit too many letters in there. Why you I messed this up good. Okay, why utility holdings during these volatile times? Because let's look at their sector, right? Technology, industrials, consumer defensive, utilities, almost 10% of the fund is utilities. You didn't see that on the other guys. What's utilities known for? It's safety in volatile times. Okay. So your big cap, your Duke Energies, your Southern California Edison, the really big, I could go on and on about and you guys probably know one from your states and areas, but your big power companies pay good dividends, right? They're not the best growth stocks. They have their times, but they're known for good dividends. It's a core thing. When the old saying is, when the lights go out, that's when people panic, or if somebody's generator goes off, or if you're on life support or something. So power comes down to being pretty critical in first worlds. And so if you want to invest in power companies, and you're seeing it even in the large data centers now, you have a whole different area where these power companies are scrambling. I think uranium is a brilliant way in the future for that with these small modular reactors, SMRs. But let's look at these guys across, and they're getting some of this lack of loss when the markets go down in a bear market by carefully weighing out this trailing dividend over the last 12 months. Now, they're doing it for a short period of time, but it's fabulous. These utilities just in volatile times, they're stable. And I don't know what this, I know March is going to be ugly reasonably. I just don't know how ugly or how long. And we've already kind of started into it. So XLU, if you want to go out and just look at an index, I think it's Select. I don't know if it's Fidelity Select, but it's a fund family of utility companies. So that's probably what they're doing, and just buying the XLU index. They could be going out and buying some particular utility companies. And so last week, what did the QQQ do over the last 7 trading days or 5 trading days? It was down 4.63%. How did XLU minus 0.5% basically? So those are things to be aware of. What's their grade? Well, their dividend grade is a C. They're not a big payer here, right? I really need I believe this should be set for their data, which is FDVV. I think I used the format and just didn't change. Okay. Yeah, it definitely. So you got C pluses, you got a D here. Again, you got an F. Well, look at it. You got 0 years. So FDVV may get hurt in the future due to its criteria of selecting dividend companies with 1 year history. Most of us like longer time in that. That's fairly aggressive, and that could come back to bite them. But overall, you're talking about something that's done really, really well. You got a 3 year total return FCHD 22.9, DGRO 3108, and these guys are playing with some big tech, but they have a lot of other stuff. It's still only a quarter of the fund, their big tech portion. It's a big portion, but they've managed, as I mentioned to you in that last downturn, and they were a month. They came out and not, oh no, this one's 9/12/2016. The last one that I'm going to cover came out in like February of 2022. Sorry, guys, just mixing up some of those. All right. So overall, I think these guys are a good choice. This is my only concern here in red. All right, let's look at CGDV, Capital Group High Dividend. CGDV, look at this. I told you I was saving the best for last. CGDV, 3-year total return with dividends reinvested over 54%. So you had a 50, a 40, a 30, and a 20. All top funds in my book. Okay. Can I get more in a year? If I told you about Coney and Misty and Vidi and Pulte, PLTY on Palantir? Absolutely. And at times those guys can run. But we just saw a perfect example with the pullbacks in these things. It was brutal. And it's bound to happen. I had sold out in my Palantir, both in Palantir and my PLTY, and then bought back in uh, with this carnage. And my expectation is that it slowly recovers out of that. That doesn't mean in March that it doesn't go down a little more. We shall see. All right, guys. So, Meta, what do they own? This is the final category, the final one. Well, they own Meta, Microsoft, RTX, and then they start going into healthcare. So they're at a 20%. Well, I take it back. They're only 15% in tech. Let me do one other thing here on my second screen while I'm recording this. Okay. So RTX is a little bit more in the aerospace segment. So United Health, healthcare, GE Aerospace, that tells you American International Insurance, right? Consumer Cyclical, Carrier Global. I assume that's the Carrier air conditioning. I could be assuming wrong, but let's see what it says. Yeah, AI, but now, even they are doing AI driven data center cooling solution, right? But it's Carrier. My father was in the air conditioning or refrigeration business. And so I knew Carrier. They used to wear on the back of their shirts Carrier logos. All right. So a lot of stuff, energy, basic materials, utilities is a small footprint, but technology is down. They're pretty diversified. This one launched in 2022. Management fee double, right? So we went from 0.06% to 0.08% to 0.16, which is double the second one, and to 0.33. But still, overall, pretty small. You guys that are, those of us who have been in some yield max and some really aggressive stuff, we're paying 0.99. It's triple this, right? But that's why we don't like underperformance and we don't like it if they're not active. I will tell you right here and now that this is an actively traded, by far the most of all of these. This is written in stone that it will be active. Okay. So CGDV is actively managed, hence a little higher management fee. MGM management is my abbreviation for management fee. So this active manager involves 5 separate portfolio managers involved in the ETF. So you see the names over on the side. This is all out on the website. Okay? Capital Group. Um, Telco, Christopher, Bookbinder, Telco's Autos, Auto Parts and Equipment, and next person, Martin is in Industrial Machinery, Electrical Equipment, James Lovelace, Beverages, Tobacco, Consumer Typicals, Restaurants, Household and Personal Products. Then you've got more commercial, Keiko, then Aerospace and Defense, IT, Machinery, Business Services. James Terry, Healthcare Supplies and Equipment, Pharmaceuticals, and Biotech. Okay. So the goal, again, this is written out there on the website. Some YouTubers love to show the website. I like to capture it all and just put it in this format. Probably be faster and easier just to go to the website, but I don't know. So the goal of this actively managed fund is to produce income exceeding the average yield on U.S. stocks generally, and to provide an opportunity for growth of principal consistent with sound common stock investing. Sounds pretty good. Again, actively managed. The fund primarily invests in large cap U.S. stocks, but can hold up to 10% of assets outside the U.S. Additional fund facts are listed below. Right now, they're holding about looking on the site, 5.04% are non US based companies. So I know that sometimes in comments people ask me that kind of stuff. So here's what I was talking about the comparison. I said, "Oh, I didn't tell you guys the launch date and the percentage and what the assets under management So here we are, SCHD, right? In summary, DGRO, CGDV, FDVV. So this was number one that I talked about. This was number two. So this guy over the 3-year total return, 22% yielder or total return, 30. Then we went to 40 with FDVV, and we went to 50. And so this 50 is 54.3 is a little more of a specialized with more fund managers actively, their selection process. We shall see, but also newer, right? When they get a 10 or 12-year record, let's see if they're the leader. When you look at their dividend grade overall by those that grade these kind of things, C plus. Dividend yield itself 1.53, probably the lowest yield. Okay. And I'm about to go to my database in a minute and summarize this stuff for you. And then in the comments, let me know what else you want to see. I'm going to cover some other funds that I could have easily included in this list. Right. I shouldn't say easily, but there were some other funds that I could have put in this list. These are very popular. I don't know if everybody knows about CGDV. I know everybody knows about SCHD, and I know people are aware of DGRO, but I'm not so sure on the Fidelity. Probably on the Fidelity, just by the fact it says Fidelity High Dividend. All right, guys. So overall, a good set. Here is the database that I have built, and I query it. I do a lot of things with it. So what I wanted to do was when I grabbed iShares, I had other companies in here. So I can easily just go here and get rid of the other two that were in here. Okay, now this is what I was talking about today. So I have 100 and something, and I'm adding. I expect this to finish up around 250. So I create fund families. So I just search on a fund family. Then I search within the fund family on what ETF type. I have things like single stock. If it's a yield max fund on MSTR, then that's a certain type. What's the category? Crypto, BTC, right? Um, and then do they pay weekly? Do they pay monthly? Or do they pay quarterly? What I've been talking about today all pay quarterly. You don't care as much, but let me tell you on the monthly payers and weekly payers, I have all here for what week they pay. But there's some people that the euphoria from that payday, that's why Roundhill is coming out, and I'm going to do a video. I cover them every week, and I talk about XTTTE, QDTE, and RDTE, which is their SPY and their QQQ and their Russell Index, where they pay weekly. And they're pretty nice yields, okay? We're just starting to stumble in the market, so you're not going to earn as much. But that's why I break down my database the way I break it down. I don't think there's anything out there like this. Okay. So I'm really looking to utilize this for my videos at the end, hence why I'm talking about it. So it's in Google Finance and Google Sheets right now. I started it in Excel and ported it over. And so all of my current prices are up to date. My 3 month and 6 and 12. Why am I doing that? Because I'm reporting yields across those time periods, and I'm also breaking down my perception of total return into a 3 month NAV and a 3 month yield. And then those two numbers added together is what gives me this. So let's take CGDV, okay? And so I have two categories in order to get this total return. How did the fund do with a yield? Well, we already said this is one of the lower yielders, right? So Capital Group, and over to the right, I have all of their dividend payments on the last 4 quarters. So if you go all the way over here, so they paid 18.5 cents, 15.1, 0.129, and 0.10. So those were the March, June, and September and December. So come March, you'll see another payment. But the important thing is there's your yield. Here's your 6 month yield. If you go back, you include more. If you go to your 12-month yield, and then here's your 3 month NAV. Okay. So when I add 50.5 to 0.19, that's my total return. So looking at the 3 month total return, the only positive guy out of the four funds that I covered, okay, and again, timing can be good or bad. If we go 4 months or 6 months, yeah, look at 6 months. You're still your best performer is CGDV, which I had said to you is the high yielder. How about 12 months? Same thing, but they're close, right? So you got 19, 14, 17. And look at CHD, SCHD. They've got a 12-month, or sorry guys, I'm looking at the wrong column. This is what you care about. So it's darn close. If I go over 12 months, I got a winner of 21.23 with CDG RV, but my FDVV, which was the 40% yielder, I think on that 40% gainer on the 3 year, is close, even SCHD. But look at the breakdown of where FCHDs. So FCHD's yield, look at the 12-month yield. It isn't even close. 9.5 for FCHD. It's a high yielder. 337, 252, 182. So of its 20%, it's getting almost half of it in its dividend yield. Whereas these guys aren't, right? This 21 is 19 of it is coming out of growth. So it gives you a chance when you look at these things. And I start picking up trends on the 3 month on what's happening. I compare what's happening in the market and which funds are doing it. And when I have, 150 going to 250 of these, I can look down a whole bunch of them. Now, granted, I got some real high yield on single stocks that are super volatile, right? But I think this stuff is really worthwhile for you to take a look at and just hit me up with questions. Ask for me to look a comparison in here. Which videos do you want to see? Because again, I'm trying to reach out to an additional audience that I consider a little bit more conservative than just guys that chase the high yield and yield max and get into some of the dividend traps. Okay, guys, again, this is Bruce with Targeted Wealth Creation. I hope you enjoyed this. Please subscribe to the channel. I want to grow this. It's why I'm building my database. I'm trying to do other things. Probably more than half of my current viewers are not subscribers. Subscribe to the channel, comment. I've got some loyal people that comment a lot, but I really want to grow this thing. That's why I'm making the additional effort. Okay, guys, again, not financial advice. I'm not a financial advisor. Bye for now.